Federal Drive is presented by GEHA, Government Employees Health Association, proudly providing health and dental benefits to federal employees and their families. Visit GEHA.com.
And now, the Federal Drive with Terry Gerton, sponsored by GEHA.
Welcome to the Federal Drive on Federal News Network. It's Thursday, December 4th. I'm your host, Terry Gerton, and I am glad you're here. Coming up on this hour of the Federal Drive, PSC's Vision Conference proved that forecasting government contractor workload for 2026 is no easy task. Plus, a new CFPB rule strengthens credit data standards, helping lenders assess risk and borrowers access affordable credit. Those stories and much more ahead during this hour of the Federal Drive. We begin with this. The Technology Modernization Fund is running out of time. In 8 days, the reauthorization will expire for the 8-year-old government account that helps agencies update IT systems. That is, unless Congress acts to extend the TMF. For more on what it would mean if the TMF would expire, Federal News Network's executive editor, Jason Miller, joins me now. Jason, good to have you.
Always a pleasure.
Let's start at the beginning. Some folks are familiar with the TMF, but others might not be. Back us up on what it is and why it's expiring.
The Technology Modernization Fund is one of two really big pieces of a bill that was passed and signed into law in 2017 called the Modernizing Government Technology Act, the MGT Act. The TMF was created to really have a centralized government-wide IT modernization fund, exactly what it says. Hey, I'm an agency, I have this big, ugly problem that I need solved. I need some extra money to really accelerate it. And that can submit a proposal to a board of federal executives, the federal CIO, the federal CISO, other people from GSA, other agencies, CISA as an example. And I can get money, I can get extra funding to really push forward this project that maybe has been slow to move or has some cybersecurity holes that really need to be fixed. And it's been fairly successful over the last 8+ years. The TMF currently manages about $1 billion worth of systems upgrades and modernization projects, 69 total investments across 34 different agencies. And on top of that, there's a lot of interest in using it. The TMF board has received about 290 proposals worth about $4.5 billion in total funding. The TMF is set to expire because in the MGT Act back in 2017, 2018, when it became law, it said, this will expire in so many years. And that so many years is unfortunately December 12th of this month. So the time is ticking.
One of the big challenges of TMF was the payback provision. Agencies were supposed to pay back their loan with the savings or the revenue that they generated from these investments. How is that going?
That has been a albatross around the TMF's neck for a lot of years. And there's been attempts by the Office of Management and Budget to change that model. At one point, when they received over $1 billion from the American Rescue Act, they relieved some of that burden of the payback model, saying, hey, for certain things, maybe it's a 25% payback or 50% payback. Congress was not happy about that. They have brought that back to, hey, you should be expected to pay back 100% of your investment, of your loan, except for some circumstances which you need to negotiate with the board. And now, this administration also is saying, hey, maybe we need a totally different model that includes the payback model, but also, if you will, a pass-the-hat type model where they can collect otherwise expired funds from agencies to put in the TMF to use as loans, as investments across the government. That model is awaiting, again, legislative approval from Congress.
What would happen if the program does lose its authorization?
There's two things. The first, the current funded projects would remain. If there's money already allocated, they would still get their money. So the TMF board gives money out in tranches. If you get a $15 million award, you just don't get $15 million. You may get $3 million this year and $6 million another year, as you've shown progress, as you've shown improvements, as you've shown really modernization steps that you've taken and successful ones. The big problem is new investments would stop. The TMF board would no longer be able to make new investments in new projects. And as I said earlier, Terry, there's dozens and dozens, hundreds of projects waiting in the wings, proposals. And in fact, the board only made one new investment in all of calendar year 2025. So obviously, there's a lot of money that also could be frozen. According to GSA's budget justification, now GSA runs the TMF Program Management Office. There's upwards of $150 million in the TMF fund. Now, some of that is for existing projects, but some of that is for new projects too. So a lot of that would be on hold. And if they don't use it, the chances of it potentially going back to the Treasury is if it's not renewed is also in part of that discussion.
You mentioned that the administration and Congress are thinking about some other models for technology investment. Are they interested in extending the TMF as is? What are you hearing there?
There's a lot of interest among some members of Congress, and I think the administration as well, to extend the TMF. I know that, for instance, Congresswoman Nancy Mace and former Congressman Jerry Connolly introduced the Modernizing Government Technology Reform Act back in April that included an extension of the TMF through December 31st, 2031. Unfortunately, that bill never got out of the House Oversight and Government Reform Committee, and there's no Senate companion. I also know that Nancy Mace tried to put a provision in the Defense Authorization Bill for 2026 that would also extend the TMF through 2031. That was not picked up during the big amendments process. I did hear from a spokesperson for the Oversight and Reform Committee, and they are going to try once again during the conference committee to put an extension in the NDAA for the TMF. They are hopeful that there's a lot of support for it. I know in the Senate, there is some support. Gary Peters, the ranking member of the Homeland Security Governmental Affairs Committee, is supportive. However, there are some other concerns. Senator Rand Paul, the chairman of the committee, is not such a big fan of something like the TMF. So it's unclear whether or not this will work or not. As for the administration, I did get a comment from the General Services Administration. They obviously want to work with Congress to make this happen. The Office of Management and Budget, unfortunately, did not respond to repeated requests for comment about where the federal CIO, Greg Barbaccia, and others stand in terms of trying to get this expiration extended.
What does industry say about this, or do other segments support the TMF as a way to move forward on some of these big projects?
The TMF has always been really interesting. There's always a lot of excitement in industry about it. And I don't think a lot of folks in industry initially understood what it was and how it worked, right? Because it was supposed to be for projects that were already ongoing, not new contracts. But I think over time, industry and others have seen the value of the TMF. I know there was a letter written by the Alliance for Digital Innovation, ADI, to the leadership of Congress, advocating for the extension of the TMF. So that also is a big push. So I think there's a lot of support from industry. I also talked to some former government folks. Gundeep Ahluwalia is the former Labor Department Chief Information Officer. During his time at Labor, he helped Labor win 6 different funding investments from the TMF for different projects for Labor Department. And he said, listen, the TMF really helped the Labor Department pay down its technical debt. It was all about improving services, improving cybersecurity. That money just isn't there otherwise. The funding model to improve federal IT investments is hard to come by. So much money is tied up in operations and maintenance that finding that extra bit of funding to really accelerate a program is difficult many times. At the same time, I also talked to Larry Bufundo, the former executive director of the TMF Program Management Office. And Larry also said, listen, there are ways that agencies can find modernization money, but again, it's few and far between. And unfortunately, there's not enough government-wide plans to say, okay, how are we going to address this issue? How are we going to do this as a group? And the TMF provided that really focus from not just this one agency, but what the idea was, hey, if one agency has a problem with a system, they can then use that experience to help other agencies modernize systems, move toward a shared services model. So there's a lot of benefits of having this kind of centralized fund.
Lots to watch over the next few weeks for this important program. That's Federal News Network's executive editor, Jason Miller. Jason, thanks so much.
Always a pleasure.
You can find this story at federalnewsnetwork.com. Up next, a new CFPB rule strengthens credit data standards, helping lenders assess risk and borrowers access affordable credit. This is the Federal Drive with Terry Gerton on Federal News Network. Welcome back to the Federal Drive with Terry Gerton on Federal News Network. The Consumer Financial Protection Bureau has issued a new rule that reinforces national standards for credit reporting. It confirms that federal law takes precedence over conflicting state rules, a move the Consumer Data Industry Association says will improve consistency, lower costs, and protect access to credit. Dan Smith, President and CEO of CDIA, is here to explain what the rule means for lenders, borrowers, and the future of credit data. Mr. Smith, thank you for joining me today.
Terry, thank you for having me. I really appreciate this opportunity.
CFPB recently issued a new rule regarding the Fair Credit Reporting Act, and it's pretty important. Can you walk us through the core of that rule and why you at the Consumer Data Industry Association think it's important?
Sure, I'm happy to. So the Fair Credit Reporting Act has been in existence since 1970. The leading privacy legislation in the country has specific requirements that lay out how credit reporting should take place, the protections for consumers, and a clear process. And one of the core functions of the Fair Credit Reporting Act is to have a national standard and clearly discusses preemption. Throughout the years, it's been amended several times. But in the end, Congress is the one who makes decisions on the law. They write the law, and it's up to judges to interpret the law. In 2022, the CFPB, under the previous administration, put out a document called the Interpretive Rule on Preemption, where they decided what the statute meant. So the first problem was that CFPB actually doesn't have the authority to do that. They're not the judge. They implement regulations. They don't interpret law. That's up to the courts to decide. They clearly decided to go against the congressional intent of the FCRA. And the current administration believes that that is not their role. That is up to Congress to decide the law. And they were attempting to state that fact, right? So they basically went back to what was common knowledge of the interpretation on preemption to what it was prior to 2022. And they acknowledge in their current interpretive rule that this is not binding. Just like the 2022 rule was not binding. It was an interpretation, right? It didn't go through the APA process, right? We couldn't sue in 2022 because they didn't write an actual rule. They just said, this is what we believe. So the current administration is saying, you don't have the right to say this is what we believe. That is up to Congress. You probably remember the Loper-Bright case, which basically said Congress writes the laws, right? If they're ambiguous, the regulators actually don't have the flexibility to interpret it. It's up to Congress. So I believe the current administration is trying to get the market back to where Congress intended years ago.
What does this all mean for both consumers and lenders who have to use this kind of data?
The credit reporting ecosystem is critical to every consumer in this country. It provides access to credit. It provides the lender with the ability to mitigate their risks, to analyze a consumer and their ability to repay the loan. It helps facilitate the buying of a car. You can walk into an auto dealer and walk out with a $50,000 car today. And a good reason is because of the credit reporting system. It allows the lender to evaluate the consumer with data. They're not making judgments. They're not looking at the person. They are making a decision based on data that talks about their ability to repay the loan. So every day consumers benefit from a robust, complete, accurate credit report. The good, the bad, and the not so good. And if you have a system that doesn't intake the completeness of a consumer's credit, then you're going to have decisions that are not accurate. And a lender has two basic choices at that point. They can cut back on their lending, lend to less, or they can charge people more because they're taking on more risk. Those are their two levers. So the more complete and more accurate a credit report is, the better the lender is going to be able to manage their risk and lend to more people.
I'm speaking with Dan Smith. He's the CEO of the Consumer Data Industry Association. So in the interim between the previous administration's interpretive rule and this one, some states tried to create their own standards on credit reporting. Were there any particular state actions that raised a red flag for you at CDIA?
Yes. The reason CDIA is so concerned about the state action is that Congress is the decider of what can and can't be on a credit report. And it is critical that we have a national standard, that the same data, same types of data appear across the country so that there is a system that a lender can rely upon if they're lending in California or they're lending in Nevada or they're lending in New Jersey. The credit score that's based off that information is consistent across the country. If you had data in California that's different than data in New Jersey, that means the score would act differently. A 750 in California that doesn't have medical debt would perform different than a 750 in New Jersey that does have medical debt. And I don't know how a lender can manage a network of 50 different credit reports, 50 different credit scores. And there aren't just two credit scores, FICO and Vantage score. There's 50 or 60 different forms of credit scores based on the lender. It's a complex weave, and it's important to have a national standard so a lender can evaluate the consumer on a level playing field. And if you allow someone other than Congress to determine what can or can't be on a credit report, you're bringing politics into the decision making, not sound underwriting decisions. So today's medical debt, tomorrow's student loans, next week is homes damaged by a natural disaster. And before you know it, that credit report is less valuable to the lender, and they stop buying the credit report and using it as a tool to lend more.
You mentioned medical debt along with some of the others. There was a recent decision in the Eastern District of Texas having to do with medical debt that vacated a CFPB rule. Was that in line with the new rule, or was that related to the old rule?
So we actually filed that case, CDIA, along with Cornerstone Credit Union League out of the Texas area. So you have two things. You have the current interpretive rule, which they talked about preemption and what a state can and can't do. That's what happened last week. Back in January of 25, the previous administration, as they were leaving, finalized the prohibition on medical debt from being included in credit reports, right? We and others sued saying you don't have the legal authority to determine that, only Congress does. So back in 1996, Congress actually prohibited medical debt from being on credit reports, right? People don't realize in 96, they said no medical debt. We don't think that's correct. In 2003, they came back and said, oops, that was a mistake. When somebody has $50,000 in any kind of debt, a lender needs to know that so they can make the right choice and not put that consumer in a position that they'll fail. You don't want to give people more credit than they can actually afford. So Congress in 2003 passed a law saying both medical debt can be included as long as you can de-identify the medical institution. So if you are a patient at Sloan Kettering, this was an actual example by Congress. If you're a patient at Sloan Kettering and your credit report says medical debt, $5,000 Sloan Kettering, the assumption can be made very easily that you have a medical cancer. They don't think that was fair, and they made a decision that you could put the medical debt, but you have to, quote, code it or block the identity of that company, the Sloan Kettering. But it says you can definitely put the information on there. So they completely reversed their opinion and said it's important. So what happened was in 25 in January, the administration and the CFPB said, we don't agree with Congress, we're going to take it off. And they used some data and some analysis and a lot of hyperbole and said, this isn't fair to the consumer, so we're going to take it off. Well, they don't have the authority to actually do that. So the lawsuit in Texas was to say the authority the Bureau has is to implement regulations, not make law. And the court agreed with us completely.
I've been speaking with Dan Smith. He's the CEO of the Consumer Data Industry Association. Thanks so much for bringing some clarity to what is, to the layperson, a pretty complicated issue.
Well, thank you for having me.
We'll post this interview at federalnewsnetwork.com/Federal Drive. Subscribe to the Federal Drive wherever you get your podcasts. Still to come, outdated SEC communications rules are putting compliance and competitiveness at risk. But first, PSC's Vision Conference proved that forecasting government contractor workload for 2026 is no easy task. This is the Federal Drive with Terry Gerton on Federal News Network. Welcome back to the Federal Drive with Terry Gerton on Federal News Network. Timely payments, rescinding stop work orders, and monitoring long-term impacts are top priorities as agencies restart operations. We'll also look at key takeaways from PSC's Vision Conference with CEO Jim Carroll. Jim, thanks for joining me.
Terry, thank you so much for having me on.
You are coming off 2 days of the PSC Vision Conference. Let's start there. What were the biggest insights that you heard over those 2 days of discussions?
Well, I'll say 3 insights. One was it was a brutal way to start the Monday after Thanksgiving holiday. But we had to accommodate the really great speakers, including, really some wonderful keynote speakers. Next year, it will not be the Monday after Thanksgiving. So for all of our members, for this event, we're thankfully able to get a better date. But more importantly, as I mentioned, really was hearing from, some of the leadership in the administration about what is their projections for 2026 and how the money as being appropriated by Congress as the budget request and where they expect it to go. And so, one was just the amount of money, which is something worth talking about. The other thing is really the use of AI and how the embrace of AI by the federal government is rapid, but it's also a bit unknown. We're moving forward in this space of the government using AI without everyone necessarily understanding all the implications. So I think so far those are the 2 big takeaways that we've been able to summarize. And it's a great event for our members and a few guests.
What did you hear about this administration's take on industry partnerships?
I think we have to sort of look back at DOD. I think DOD with Secretary Hegseth is a good example of that. As you recall, in November, Secretary of War Pete Hegseth met with our members and the folks that do defense contracting and said that they really do want to do a radical revolutionary overhaul of the FAR, and especially, in the sense of producing deliverables and measuring outcomes based on performance and getting this done right, and how the military, how the branches within DOD have been tasked with coming up with orders in January, by mid-January, 60 days, in terms of how they think we can best streamline the process. And, our hope is that this proposal really has legs, and we think it does. There's support in the Capitol Hill, there's support in the administration, and of course, we, the leading trade association for companies that do business with the federal government, we're completely supportive of most of these changes. There are things that we've been asking for years, that would really expedite the awards. Hopefully, with the grace of God, cut down on the number of appeals following an award, which seems to be a bit of an epidemic of companies now just expect there to be an appeal. And so, we're really very hopeful that this will stick, and we're optimistic that it will. And so that's one of the major things. And then, of course, as I mentioned, the amount of money in government services, and there was discussion about that yesterday this week from the Assistant Secretary of War, that there really is going to be an extraordinary amount of money, $850 billion at DOD, with at least $180 billion toward services. And, that's what are and I'm proud to say, patriotic companies that want to do the right thing for the warfighter and the taxpayer are eager to jump on board.
I'm speaking with Jim Carroll, CEO of the Professional Services Council. Jim, tell us more about what you heard about the deployment of AI from the government agencies and within the contractor community.
Yeah, so, within the government, we had speakers from across the government. As I said, Assistant Secretary of War, Michael Cadenazzi, who handles the industrial base policy, talked about an additional $180 billion, $200 billion in services, and how the use of AI in services can change, and how there needs to be flexibility because of AI. That when some of these contracts call for 100 seats to be filled, that there is enough flexibility that contractors can come back to the government and say, hey, we're going to use some AI, some other advanced technology. We can reduce the number of personnel, from 100 to 80 people. And in the past, there's been some resistance. Both the Department of War and some of the other departments really stressed that they want flexibility because of AI. I'll say one thing that was interesting, and we've seen and heard this from members, is that there are a fair number of new companies who have never put in bids for government work that are using AI to not only write their proposals, but as I mentioned, also the use of AI to appeal. I mean, it just seems like it's a press of the AI button, if you will, and an appeal is generated. And we need to get away from that, for valid, justifiable awards. Let's move forward and deliver, good results. And so we're very optimistic. The recognition that AI has some limitations to it, but that it can deliver fast results is something that will be very interesting to see in 2026.
Jim, one of the things that you and I have talked about, we've talked about it with a lot of contracting folks on the show, is the uncertainty about the federal government workload for contractors. I'm wondering what you heard from your members over the course of this conference, especially as we're sitting right now, just post-shutdown and possibly pre-shutdown in January. What are you hearing, and what is PSC's advice?
Harry, don't jinx us. No more government shutdowns. We're tracking January 30th very closely. We had very senior meetings in the White House, in the West Wing, with a couple different meetings because of the shutdown, to talk about the impact that it is having on results, and the impact it is having on protecting the homeland. And so, what we told them, in addition to the impacts, is when the government gets up and running, because shutdowns end. So this was a record-breaking one, but shutdowns do end. And as soon as they end, it's to tell the individuals in the departments, immediately start processing these invoices, get these payments out the door. There are a fair number of companies, especially in the small to mid-size, that really did not have stable cash flow. They really were hurting. We saw some layoffs, or at least, sidelining of key employees, and it really presented a huge financial strain on the companies, which flows down to the employees, which flows down to the communities. And so that's, what we asked for. We asked, in addition, that the momentum on getting new contracts out the door be, jump-started as fast as possible. Historically, it takes quite a while after a shutdown for things to resume, sort of a normalcy. And, we don't have time for that. In addition, to the financial impact, truly the impact on national security. The world is facing new and dangerous threats that seem to be magnifying every day. And our contractors are able to deliver world-class results and protection. And unless they get up and running immediately, those threats are very real.
Are you seeing that kind of activity coming out of the government agencies now, a couple of weeks on from shutdown?
We're actually pleasantly surprised. And I hate to say that word, surprised, but in the past, it does seem to be a bit of a lag. Our message seems to be delivered. We're getting payments out quickly. Maybe not all and not every department, but it seems, to be beating historic records in terms of getting payments out. Obviously, some companies are still hurting, waiting to get paid for work that they performed. But we're happy so far. But Terry, I can't believe you brought up January 30th of next year. Is this a lull between shutdowns? I hope not. I hope that they're able to resolve, some of the significant issues, healthcare, things like that. But, as we've talked about, there's not a lot of work days up on Capitol Hill, and we just cannot have another shutdown.
Jim Carroll is CEO of the Professional Services Council. Jim, thanks for joining me.
Thank you, Terry. Have a great week.
We'll post this interview at federalnewsnetwork.com/Federal Drive. Subscribe to the Federal Drive wherever you get your podcasts. Coming up next, outdated SEC communications rules are putting compliance and competitiveness at risk. This is the Federal Drive with Terry Gerton on Federal News Network. Welcome back to the Federal Drive with Terry Gerton on Federal News Network. The Securities Industry and Financial Markets Association is urging the SEC to modernize its communication and record-keeping rules. Robert Cruz, Vice President of Information Governance at Smarsh, joins us now to explain why the current framework is falling behind, how firms are navigating enforcement risks, and what a workable compliance model could look like. Mr. Cruz, thank you for joining me.
And thank you for having me. I appreciate it.
The Securities Industry and Financial Markets Association has recently written to the SEC asking to modernize its communication and record-keeping rules. Help us understand what the big issue is here.
Well, I think the fundamental issue that SIFMA is calling out is a mismatch between the technology that firms use today and the rules, which were written a long time ago. And in some cases, the Securities and Exchange Act from 1940. So essentially, we're all struggling trying to find a way to fit the way that we interact today into rules that are very old, written when we were doing things with typewriters and, over written communication. So it's trying to minimize the gap between those two things, between the technology and what the rule requires firms to do.
So instead of all of those hard copy letters that we get from investment firms and those sorts of things, we also get emails, text messages. That's where the disconnect is happening?
Yes. It's the fact that individuals can collaborate and communicate with their customers over a variety of mechanisms. And some of these may be casual. They may be not related to business. And that's the fundamental problem, is that SIFMA is looking for the rules to be clarified so it pertains only to the things that matter to the firm, that create value or risk to their business or to the investor.
And what would those kinds of communications look like?
I think what they'll look like is external communication. So, right now the rule doesn't distinguish between internal, you and I as colleagues talking, versus things that pertain to, communications with the public or with a potential investor. So it's trying to carve out those things that really do relate to the business's products or services, and exclude some of the things that may be more just conversational, as you and I might pass each other in the hallway. We can chat on a chat board someplace. It's trying to remove those kind of just transitory communications from the record-keeping obligations.
Right. The letter even mentions things like emojis and messages like, I'm running late.
Exactly. And, it's a fundamental problem that firms have, is the fact that if you say you're going to be able to use a tool, even if it's as simple as email, that means that our firm has an obligation to capture it. And when it captures it, it captures everything that is delivered through that communication channel. So that creates some of that problem of somebody left their lunch in the refrigerator. We need to clean it up. It's trying to remove all of that noise from the things that really do matter to the business.
Not only does that kind of record keeping impose a cost on the organization, the reporting organization, but it also would create quite a burden on the regulators trying to sort out the meaningful communication in that electronic file cabinet, so to speak.
Absolutely. Well, the firm clearly has the obligation to sift through all of this data to find the things that matter. If you have a regulatory inquiry, you've got to find everything that relates to it. Even if it's, I talked to an investor and there was an emoji in that conversation, I still need to account for that. So the burden is both on the firm as well as on the regulator in trying to parse through these very large sets of data that are very heterogeneous, with a lot of different activities that are captured in today's tools.
Relative to the question about the tools, you've said that SEC rules should be agnostic to technology. Unpack that for me. What exactly does that mean?
Sure. And this kind of goes back to a few years where there was a revision to the Rule 17A4 from the SEC, which is the fundamental record-keeping obligation. It says you need to have complete and accurate records. What they tried to do at that time was remove references to old technologies and spinning disks and things we used to do long ago. And so the objective was to be more independent of technology. Your obligation is your obligation. If it matters to the business, that's the principle that should govern, not the particular tool that you use. So technology being agnostic, or rules being agnostic to technology, means it doesn't matter whether it's delivered via email, via text, via emojis, carrier pigeons, or anything else. If it matters to the business, it matters to the business.
How do today's variety of technologies complicate a business's compliance requirements?
The challenge is very complex, period. It's always going to be with us, because there's always going to be a new way that your client wants to engage. There may be a new tool that you're not familiar with that they want to interact on. Or you may get pull from your employees internally because they're familiar with tools from their personal lives. So that encroachment of new tools, it doesn't go away. It's always been with us. And so it's things that we have to anticipate, again, be agnostic, because there's going to be something that comes right along behind it that potentially makes, an explicit regulation irrelevant from the outset.
I'm speaking with Robert Cruz. He's the Vice President for Regulatory and Information Governance at SMARSH. All right, let's follow along with that, because you've got a proposal that includes a compliance safe harbor. So along with these compliance questions, what would that change for firms, and how does it address the challenges of enforcement?
Well, it's an interesting concept, because the rules today are meant to be principles-based. They're not prescriptive. In other words, they don't tell you must do the following. And that's one of the challenges the industry has, is that what is good enough? What is the SEC specifically looking for? So this is like trying to give people a safe spot to which then you can say, well, SEC, if you really care about, particular areas of these communications, they can tune their programs to do that. So it feels like it's just giving some latitude so that we can define best practices. We can get a clearer sense of what the regulators are looking for. It'll guide our governance processes by just having a clearer picture of where enforcement's going to be focused.
The regulatory process that would apply here is notoriously slow and complicated. What's at stake for firms and investors if we don't get this modernized?
Well, I think you're going to continue to see just a lot of individual practices that will vary. Some firms will interpret things differently, and we'll need to wait for enforcement to determine which is the best way. So case in point, generative AI. If you're using these technologies inside of the tools that you currently support, are these going to be considered issues for the SEC or not? We have to wait until we get some interpretation from the regulators to say, yes, we need to have stronger controls around this, or yes, we need to block these tools. You need to make that adjustment based upon the way that the SEC responds to it.
And what is your sense of how the SEC might respond to this?
My gut tells me that just given where we are right now, the SEC has a reduction in headcount it's dealing with. It's stating its mission very clearly, and its focus is on crypto, is on capital formation, is on reducing regulatory burden. I just don't know if this makes the list. So it clearly is being advocated strongly from SIFMA, but whether this makes page one of the SEC priorities list with a 20% reduction in headcount, it really seems like outside chance that it gets onto their agenda.
Could it inform some of the other regulation issues that they're addressing, such as crypto and capital formation?
Absolutely. And that's a great comment, that the notion of using an unapproved communication tool, it didn't go away. We may not see the big fines anymore, but I think the regulators are going to be saying, if there's an issue related to crypto, related to investor harm or what have you, if you're using a tool that is not approved for use, you don't have the artifact, you don't have the historical record. They're not going to view that favorably if you're not able to defend your business. And so it'll come up in context of other examinations that they're carrying out. So maybe not a means to an end as it's been for the last 2 years, but it will impact their ability to do their jobs, ultimately.
I've been speaking with Robert Cruz. He's Vice President for Regulatory and Information Governance at SMARSH. This is a really complex issue, so thanks for helping us get clarity.
Sure. Thank you for your time.
We'll post this interview at federalnewsnetwork.com/Federal Drive. Listen to the Federal Drive on your schedule and device. Subscribe wherever you get your podcasts. The Federal Drive with Terry Gerton is produced by Eric White and Michelle Sandiford. Our web editors are Daisy Thornton and Stephanie Wright. For the latest updates, stay with federalnewsnetwork.com or follow us on Facebook, YouTube, and LinkedIn. Up next, the top national headlines from CBS News and the Federal Newscast. I'm Terry Gerton. Thanks for listening.
And now, The Federal Drive with Terry Gerton, sponsored by GEHA.
Welcome to The Federal Drive on Federal News Network. It's Thursday, December 4th. I'm your host, Terry Gerton, and I'm glad you're here. Coming up on this hour of The Federal Drive, PSC's Vision Conference proved that forecasting government contractor workload for 2026 is no easy task. Plus, a new CFPB rule strengthens credit data standards, helping lenders assess risk and borrowers access affordable credit. Those stories and much more ahead during this hour of the Federal Drive. We begin with this. The House Oversight and Government Reform Committee has just advanced an array of bills, including many that would impact the federal workforce. Some legislation, such as a bill to overhaul the probationary period, passed just along party lines. But other bills, like one that would standardize training for federal executives, received unanimous committee support. Here with the details is Federal News Network's Drew Friedman. Drew, thanks for joining me.
Thanks for having me, Terry.
You mentioned one bill that advanced would change the probationary period for federal employees. That's certainly been a topic of interest over the last year. What would the bill do?
So this bill, it was called the Equals Act from Representative Brandon Gill of Texas. And what this bill would do if it was enacted is double the length of the probationary period. Normally, federal employees who are either newly hired or promoted in the government have to serve a one-year probationary period in most cases. This bill would push that standard to 2 years for most new federal hires, with a couple of small exceptions. Under the legislation, agencies would also have to actively certify or check off any probationary employee to say that, yes, this person advances the public interest before that employee can become tenured or removed from the probationary period. Anyone who is not certified in that way by an agency would be terminated from their job at the end of the probationary period. And Representative Gill, who introduced the legislation, said this is all building on an executive order from President Trump back in April, and he explained a little bit more.
President Trump could not be more right. Probationary periods and trial periods are long-standing essential tools to ensure newly hired federal employees are sufficiently performing before their appointments are finalized permanently. An employee can often work for the federal government for over 25 years, and having an extra year probationary status to ensure the right employee becomes career tenured is a common sense good government measure.
And again, that's Representative Brandon Gill, a Republican from Texas. That executive order that he referenced, it similarly required agencies to review and sign off on probationary workers. So what he said is the intention here is to make sure that new federal employees are carefully reviewed. He said there's been a history here with reports from the Government Accountability Office, for example, saying that there need to be reforms to those periods as well.
Since that one was a Republican-sponsored bill, did the Democrats have a different position on the probationary period?
That's right. There were a lot of criticisms from Democrats on the committee this week about this legislation from Republicans. It advanced, as you mentioned, in a party line vote of 24-19. Committee Democrats, they said that they were worried the probationary period changes would open the doors to more terminations of probationary workers. As we all recall, earlier this year, around February, tens of thousands of probationary employees were fired, and it led to a lot of legal issues and battles there. They also argued, the Democrats in the committee said, that extending the length of the probationary period could negatively impact federal recruitment, and maybe people wouldn't want to join the government if they knew that for 2 years they wouldn't have appeal rights or have a lot of rights as an employee. So there were a lot of different concerns from Democrats here, and Representative James Walkinshaw of Virginia offered a little bit of his thoughts as well.
Extending the federal employee probationary period from 1 year to 2 will give the Trump administration yet another tool to weaponize against federal employees who they perceive as ideological threats, and to continue their efforts to destroy the nonpartisan civil service.
Well, it will be interesting to see what happens to that one. There was a separate bill focused on official time, another topic that's gotten a lot of attention over the last year. What was in that bill?
That's absolutely right. So this legislation would require agencies really to just report in greater detail on the use of official time. It wouldn't change the amount of official time that federal employees use, but it would require agencies to report on an annual basis how much official time is used each fiscal year, and to justify any increases that occur in the use of official time. This, of course, refers to on-the-clock work hours by some federal employees when they are working on things like negotiating union contracts, helping employees file complaints or grievances against an agency when they're dealing with disciplinary actions or other disputes with management. So this is a type of work time that some federal employees who work as union representatives use. That's something that's come under a lot of criticism from the Trump administration and from Republicans who, believe that there really shouldn't be as much use of official time as there is. So it seems like what they're looking for here, and again, this was passed along party lines, what they're looking for here is to, just try to get more information, at least on how much it's being used. The bill was introduced by Representative Virginia Foxx of North Carolina, who explained her positioning on the bill as well.
The Official Time Reporting Act will let the American people know exactly how much of their hard-earned money is spent not providing valuable services, but on federal employee union activities.
Well, there's currently a lot less union activity going on, but what did Democrats have to say about the proposal?
They described this as an attack on union rights was some of the language that they used. They said that generally that official time is used for activities that support federal employees, and they said that it could be possible that having this closer eye on official time might let the Trump administration further limit union rights. As we remember earlier this year, President Trump signed a series of executive orders that told agencies to remove collective bargaining agreements from a lot of agencies. So that's something that's definitely been a target of the Trump administration this year. So the Democrats were concerned about how this could further push the administration in that direction and remove the ability of unions to support employees when they need it. Oversight Committee ranking member Robert Garcia of California argued that official time actually has a lot of positive effects as well.
Official time is work time that employees are allowed to use for making the workplace safe, protecting workers from discrimination or harassment. Official time is important because it helps the federal workforce run smoothly. It can lower employee turnover, improve customer service, prevent expensive legal problems, and help agencies implement new programs and rules more quickly.
There's a third bill in this package, Drew, one that looks at training for federal supervisors. How did they do on that one?
So this one is a little bit different from the first two that we discussed. This one actually gained very strong bipartisan support from the lawmakers on the committee. It unanimously advanced in a vote of 43-0, so no votes against it. The bill is called the Federal Supervisor Education Act, and essentially what it would do is require agencies to really work with OPM to create training programs for federal supervisors who are either newly promoted into a manager role or who are newly hired into the federal workforce. The arguments in favor of the bill were that many federal supervisors might step into leadership roles without a lot of training, with no clear expectations for how they might be able to adjust to that role, and that some federal employees who maybe have a lot of technical expertise who end up getting promoted don't have the management expertise in the same way. So what they're trying to do here is try to create some sort of training program to make sure that people who do end up in those positions are able to, really effectively carry out their duties in that position.
What's next for these three bills? Where do they go from here?
So these three bills, along with a close to a dozen other ones, are being advanced to the full House for further consideration. The whole slate of bills, a lot of which, as you mentioned, affect the federal workforce, have it passed out of the committee with favorably. So, we'll see how the full House takes them up and what might come from here.
That's Federal News Network's Drew Friedman. Drew, thanks for keeping us up to date.
Thank you.
You can find her story at federalnewsnetwork.com. Up next, a new CFPB rule strengthens credit data standards, helping lenders assess risk and borrowers access affordable credit. This is the Federal Drive with Terry Gerton on Federal News Network.
Phil McNamara, former Assistant Secretary for Administration at the Department of Transportation, emphasizes that in government, relationships matter more than titles. On this episode of Lessons in Leadership, McNamara shares how he's led large teams, navigated the future of work, and built trust across agencies. In conversation with Shane Canfield, CEO of WEPA, he offers practical insights on leading with humility, empathy, and clear communication in today's complex federal landscape.
Hello and welcome to the Lessons in Leadership podcast. I'm your host, Shane Canfield, CEO of WEPA. Today, I'm joined by Phil McNamara, former Assistant Secretary for Administration at the Department of Transportation, and also former Assistant Secretary for Intergovernmental Affairs at the Department of Homeland Security. Welcome, Phil, and thank you for joining me.
Thank you so much, Shane.
You've spent time leading in multiple agencies, including both DHS, DOT. What's something you learned early in your leadership career that carried you over into future positions?
Before I dive in, let me just, for any federal employees listening to this podcast or recent former federal employees, I want to say, I see you, I value you, I thank you for your service on behalf of the American people. I wish things weren't happening the way they are happening now, but just a thank you. So you're right, Shane. I've been fortunate to serve in government twice now. If there's one thing that really kind of speaks to leadership philosophy, it's to listen first. I think back to onboarding at Homeland Security in 2009. Right, I was coming from politics. I was in my mid-30s at that point. I learned you have to listen first. There's always pressure to immediately sort of make your mark. But, I think if you take the time to listen to people, whether that's career staff, whether it's, external stakeholders, build the trust, you will then be set up for sort of longer term success. And, whether it's responding to a crisis or just responding to an employee concern or trying to drive some sort of initiative, employees they want to be seen, they want to be heard, they want to be respected. So I think that it's that foundational lesson.
In your time in government, you've also held multiple different roles where you were managing personnel, as you've been talking, but personnel and HR policies.
Yeah.
And how did those kinds of people-driven positions affect your leadership style?
I think, if anything, the people-driven positions has made me a better communicator. There's just so much information to process that I had to be able to express what was going on to employees and leadership in a succinct and explanatory way. And obviously, during my time at DOT, right, the administration passed the largest infrastructure, bill in a generation, right? And a big part of that at DOT was getting that money out the door, right, quickly. But it also meant that, DOT had to, hire thousands of new employees, right? Here I was, right? I had to learn about all these hiring authorities that we could figure out a way to expedite hiring and meet the demands of what the administration wanted us to get accomplished. And, I couldn't go to Secretary Pete, right, and start talking to him about the intricacies of Title V or OPM regulations for delegated hiring authorities and everything that was entailed there in the same way that I could talk to my HR directors about that, right? So I had to find a way to, get the information to where it needed to be in the form that was most useful to the audience, right? It's sort of like, what is your audience, right? And I think that really helped me cut through what was necessary and what was sort of, fluff.
Absolutely, I agree with that completely. And was there a time when you had to make a difficult decision as a federal leader? And if you could unpack that a little bit, how did you work through that challenge?
Looking back, I think one of the hardest things we dealt with was in 2021 as we were sort of, we were all remote. We still had thousands of air traffic controllers that had to report on site. But for the most part, DOT we were doing this remotely. And so, how were we going to bring employees back to the office in a safe way? It really challenged me to think sort of more holistically, realize there's not one answer. It made me be more flexible. We had thousands of employees who now had been, working remotely for 18 months. How were we going to bring them back? And I really relied on my team to be my sounding board, to help craft the best approach possible. Where I sat, right, I had the competing demands of balancing the employee concerns with the administration's priority, right? So I think it was very challenging. Employees and people are an agency, a company, an organization's most valuable asset, right? And so, I was deeply committed to ensuring that we did this in a way that was sort of very employee-centered. That, I think, was one of the hardest challenges we solved. And, fast forward now to, 2025 with the Trump administration and just, a full-fledged 5 days a week back in the office. I don't know if anyone's really figured out the magic sauce on this, whether it's the federal government or the private sector. Everyone's still grappling with that.
Yeah. If you were to go back to the start of your career, what's one piece of advice that you would give yourself now?
The first that's really easy is just to take a long view, right? Which is that, you can get so wrapped up in whatever you're dealing with in the here and now, in that day, and then just kind of take a step back and say, will any of that really matter in 5 months or 5 years? And if if it matters in 5 years, okay, yeah, invest the time and the emotional energy into it. And I think the other thing that just, I would tell myself, and a constant reminder is, people will say, oh, will you meet with this, young person who's just graduating college and looking for a job, or will you meet with this intern who's down in DC for the summer? And I always say yes. No matter how busy my calendar is, I will always say yes. And what I always tell interns and folks starting out, early in their career here in DC is relationships matter more than titles. Early on, right, you're running this rat race and you're trying to climb the ladder and get to that next rung and chase the next cool job title. But I think what truly propels someone's career is the network of people, the colleagues, the mentors, the collaborators you build along the way, and the people you work with, right? Today may become your partners down the road. So, relationships matter. Invest in those relationships. You have to show up with respect, shared values, mutual trust. But I'd say invest in relationships is just the constant reminder.
Who is one person, it can be somebody you know personally or somebody well-known, who has impacted your leadership style?
You're not going to get me to pick my favorite. But, one thing I will say I took away from my most recent boss, Secretary Pete, was just a reminder why we're doing the work we're doing, right? In particular, I think in the federal government, and, it's so easy, right, to talk in either jargon, acronyms, and so I mentioned earlier the infrastructure law, and so for instance, there's a brand new grant program in the infrastructure law called the Bridge Investment Program, and it was, I think, $15 billion over 5 years to essentially repair, rehabilitate poor or at risk of being poor, failing bridges across the country. In the federal government, we can talk about it as the Bridge Investment Program and $15 billion, right? And, what Secretary Pete always challenged us to do is talk about that in ways that average Americans would understand, right? And so what average Americans understand is if they have a bridge in their community and that bridge is frequently having detours or lanes of the bridge have to be sort of taken out of service and that causes delays, well, we can talk about the investment we're making and we're going to repair that bridge and it's going to be more safe and it's going to reduce delays or detours and it's going to save you time on your commute. That's far different than talking about a $15 billion bridge investment program, right? Anytime he would always challenge us just to constantly make the work we're doing matter to the American people. And so that's something that I take with me.
Well, this has been absolutely wonderful, Phil. Thank you so much for your time. And thanks to everybody for tuning in. This is Shane Canfield, CEO of WEPA, reminding you to empower your team and embrace challenges. Until next time on Lessons in Leadership.
Find the full podcast and future episodes of Lessons in Leadership on the Federal News Network app and anywhere you enjoy your podcasts.